So in this week's program, we're going to be talking about some popular retirement myths and maybe helping give you some perspective on whether they are true or not. And then we're joined this week on Dollars and Cents with one of our co-hosts, Christina Lamb. Good morning. Welcome to the program.
Good morning. Good morning. Thanks for having me.
You are specifically here because you are, beyond a certified financial fiduciary, you are also an IRS enrolled agent.
That is correct.
And of course, if you are a regular listener to the program, you know that at Nelson Financial Planning, we actually have a tax preparation practice that is reserved exclusively for our clients. Christina, you're a big part of that. Already seeing some early trends, if you will, in the tax landscape.
Yeah, absolutely. We've had several folks that have already dropped off their tax returns. So we have a list of the top trends that we're already seeing. So make sure you keep listening.
Yeah, early on, but some of these trends I think are going to be a part of our conversations going forward as we roll through tax season. So excited to have you join us and excited to have you, our listeners, join us as well. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast as well. To subscribe or catch our YouTube channel, just go to our website, nelsonfinancialplanning.com. There, you'll see the icons. They'll immediately connect you. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Of course, Christina Lamb, also a certified financial fiduciary and IRS enrolled agent, joins me on this week's program. And so an interesting start to the season here on the tax side. So we've got 5 different trends that we've already identified. I know on my desk, because I usually sort of look through the final tax return for our clients, I've probably seen about 4 or 5. So I know the big wave is coming, so to speak.
Yes, we've probably gotten about 70 already.
Wow.
We definitely are off to a running start. I think this is our we've had the most come in this early that I have seen so far in my 20 years here.
People being very diligent, very excited, but unfortunately some of these trends, they may not want to be all that excited when it comes to their tax return. So we'll have more on that in the program. And then, of course, speaking of running, we are actually taping this show on Friday morning rather than on Sunday morning live, because if you're listening to the show on Sunday morning, I will be in the midst of running a marathon, Christina, out. I'm running the Publix Florida Marathon over in Melbourne. So by the time we go to air on Sunday, I probably will be around mile 16 or 17.
Wow. That's impressive.
And by the time we end the show, hopefully I will not, I'd love to be able to have ended the marathon. I will not in any way, shape, or form unless I, find some kryptonite. But by the time we end the show, in theory, I will be hopefully closer to mile 23, I think. So we'll see.
Yeah. Good luck with that.
Yes.
I think the farthest I've ever gone is maybe like 10 miles, and that's not even running. Maybe hiking.
That's good. That's very good. So this will be my 4th one. So yes, often running. And then, of course, Sunday is Super Bowl Sunday. Any plans for the big game?
Yep, we're hosting a party, and we're going to have the normal shenanigans. My mom is somehow a huge Eagles fan, which I don't really understand. And my husband does this traditional football score pool thing. So we all get to enjoy
There's money riding on it.
Try to make little lines with the ruler so everybody can buy their squares.
Okay. All right. I like that. Any go-to, what's sort of your go-to dish when you're hosting a little football celebration?
Gosh. I don't know. I make a lot of home make a lot of dips, so I'm pretty infamous for my
fun.
dips.
Yeah, that's always.
There's
my
a
wife
plethora of them.
My wife does a good dip with like it's the fake crab meat, and then mixes it with mayonnaise and cream cheese.
Eric, that's one of Eric's favorites. My husband.
Okay,
Yeah.
and then puts like the little sauce, that cocktail sauce over the top of it. So
Nice.
works well with Frito corn scoops. Anyway, so if you're interested, the recipe it's on. No, it's not, because that's not the purpose of the program. But if you are a regular listener, though, there is something. And Christina, you're joining me here on the program that airs on Super Bowl Sunday. So you may not be. I think when we first talked about this, you were unfamiliar with this concept. But on Super Bowl Sunday, I always like to talk about the pseudo market indicator that is known as the Super Bowl indicator. So we got to talk about that this past week.
Yeah. So I had heard you mention it on the radio show before, but I wasn't aware of like how it all works. So it is quite interesting.
Well, it's certainly something fun to talk about, but given its recent track record, and we'll get to that, it may be time to put it to bed. But anyway, the Super Bowl market indicator is sort of a concept that a guy by the name of Leonard Coppett came up with back in the 1970s, and here's how it sort of works, or here's the premise of it. If a team from the American Football Conference wins, then that would foretell a bear market or a down market for that year. On the flip side, if a team from the National Football Conference or a team that was in the NFL before the NFL-AFL merger wins, then it would be an up market or a bull market. So if that's true, your mom being an Eagles fan, that would make sense.
Yeah. We'll be ready for a bull market.
Be ready for a bull market if the Eagles win. Now, here's the harsh reality of said Super Bowl market indicator. While it has a sort of a relatively decent track record over its 59, I guess Super Bowl 59, right? So of late, it hasn't been that good. It's been only once out of the past 9 years.
It's a little harsh, but that means we're due.
Correct. So
be
if you're
accurate
an
if
Eagles
you're playing for
fan
statistics.
and you want the market to go up, then your wind is at your back, so to speak. But
honestly, how many times can Kansas win? I mean, they're turning into the Patriots.
I know. We love that. Well, we don't love that. We don't want to challenge the Patriots' supremacy and longevity and, of course, Mr. Brady's record. So, of course, grew up in New England, so I'm always a Patriots fan. But anyway, we'll see how the Super Bowl market indicator turns out this year. If it's wrong again, that would only mean that it's been right once in the past decade.
You might have to drop that after this year.
might have to kill that as a topic on Super Bowl Sunday. But so
maybe we should move on to some other headlines.
Yes, that are much more pertinent to your money. And certainly there were a couple of big ones this past week, right?
Yes, definitely.
The week started out with tariffs and the announcement of tariffs and a pretty significantly harsh market reaction to start the week on Monday.
Yeah, markets clearly did not like that, and they rebounded a little bit on Monday and throughout the rest of the week. So technically it was short-lived, but definitely we're not happy about it.
Yeah, that kind of concept certainly is going to have major economic implications. Of course, sort of the suspension for 30 days that happened with, I guess it was Mexico first, really helped to kind of stabilize the market on Monday, and then Canada wound up kind of getting a similar 30-day extension as well. And the other thing is the data that just came out on Friday, which also is something important for investors, and that is the jobs report. So the jobs report for the month of January, despite the cold in California, despite some of the wildfires, all the wildfires out there, which would have adversely impacted some of the employment data. The economy managed to add 143,000 jobs, and the unemployment rate went down to about 4%. So a decent sort of numbers, if you will, on that. Also got some additional thoughts on kind of this tariff conversation to really help folks get some perspective maybe on kind of what these headlines are all about. So we'll do that and continue the conversation here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. You know, before we get into some of these early tax trends, which we've got a lot to talk about on that, I want to just spend a little bit of moment talking about the tariffs and kind of what we were talking about in before the break. You know, kind of that start-stop type of approach that we saw on Monday. That, as you said, initially kind of rattled the markets a little bit.
Yeah, I definitely think it stirred everybody up. It's definitely some different tactics than we've seen used in the past. And, you know, given a generation, it'll be interesting to see how it's perceived. You know, in my opinion, the past, 40 years, folks in that generation, they're kind of a philosophy of everyone gets a trophy. Right. And so that's not exactly what's going on right now.
Yeah, I think that's a fascinating way to kind of think of it. And I think there's a little bit of perspective that sort of has been lost. And I think back to the current administration, everybody says, oh, it's got a unique negotiating style. I don't know that it's necessarily unique. I think it's more the negotiating style that you would typically have seen maybe a generation ago, maybe more than a generation ago. And it kind of reminds me of kind of the traditional perspective of what a negotiation conversation is all about, whereby there has to be a winner, there has to be a loser. And that was, for the most part, kind of how those types of things were thought of. And then in the late 70s, early 80s, the Harvard Negotiation Project, which was a big thing that had a lot of influence on how businesses were run, kind of developed this win-win approach, whereby if we are negotiating a contract or an agreement, then there has to be something that benefits us. I mean, that's the fundamental concept that the folks at the Harvard Negotiation Project put out in the late 70s. And for the most part, society has kind of embraced that.
Yeah, I would think that's true.
And the problem is, though, that I think there's a lot of bad actors, and I guess there's always bad actors in the world, but maybe there's more now that they don't really be interested in a win-win, kind of strategy. Folks in Iran aren't thinking, how could we benefit and also the U.S. benefit? That's not really how they are thinking. So I guess this reversion to the more traditional negotiation type of an approach is perhaps something that we're going to see more often, obviously, with the new administration. But I think from an investment perspective, you're probably going to see more days like Monday where you have that volatility in response to kind of some of the more headline-grabbing news.
Yeah, I'd have to agree. Normally, with a little bit more push and pull, there's a little bit more instability. So.
Yep. No, that is true. And I think just as you point out, the generation that's been brought up with everybody gets a trophy, and the reality is the world doesn't work this way. Or when Russia wants to take over Ukraine, they're not looking. They're not looking to hand out.
That's not a win-win.
Yeah, that's
that was not a win-win.
There's no participation trophies in that. But anyway, just some thoughts or some additional sort of more personal thoughts on tariffs and just perspective, if you will. But we'll shift gears. We got some perspective to share with our listening audience about taxes.
Yeah, definitely. So, some of you may have not even received all your tax documents yet. We've had quite a large handful of clients that have already turned in their taxes to be worked on, and we're starting to see some trends that will pretty much carry through the entire tax season. So we have the 5 top tax trends that we're already seeing this year that if you haven't started working on your tax return, you might want to get prepared for.
Correct. So some of these will be a little bit of a surprise,
yes,
right?
Most of them are not deductions.
Yeah, they're not
teaser.
going to be to your benefit. All right. Well, so what's the first one kind of spin off of?
So the first is higher interest rates. Now this trend is twofold. It's referring to interest received as well as interest paid on things such as your home mortgage.
So hopefully folks have taken advantage of that. We've certainly talked about that at length on the show over the course of the past couple of years. Interest rates for the better part of a decade plus were basically zero. So whether you had your cash sitting at the bank or whether you had your cash sitting in a money market, whatever the case may be, there really wasn't a whole lot of interest. Didn't matter. It wasn't going to pay anything. But pretty much for the entirety of all of last year, right? Because the Fed started raising rates 23. So in 24, you kind of were at that peak rate for the vast majority of the year, which if you had done the smart thing and done like a high yield savings or a money market, you were probably making 5% on that cash.
Absolutely.
So if there's, let's say you got 50,000 in an account. So the 50,000, 5%, making a little over $2,500 for the year. Well, that's an additional income item that you're going to have to put on your tax return.
Absolutely, and that $2,500 is fully taxable to you, and that's increasing your adjusted gross income as well.
So if I'm in the to put some numbers on, if I'm in the 22% bracket, okay, which most Americans are, and I've got an extra $2,500 of interest, well, my tax bill, 22% of $2,500, that's $550. Yeah. So my tax bill just went up by $550. Yay! I made better interest for the first time in the better part of, well over a decade. But
and now you're paying a quarter of it back.
Now I'm paying a quarter of it back. So anyway, but at least there is at least a little bit of a silver lining with the higher interest rates. What's that all about?
Well, and to some extent is the mortgage interest. So while you are paying a higher rate on your mortgage, you do get to deduct your mortgage interest if you can itemize. And so the point here is just to see, maybe you haven't itemized in the past, but if you came close and you've recently got a new mortgage, make sure you speak with your tax preparer and see if you are now eligible to itemize your deductions.
Certainly something to look at. And to that point, Christina, it's never good to pay extra interest on a loan, but at least if it's a mortgage, then you wind up at least having the ability to write it off. But you've got to fit the box of being able to itemize and not take the standard. Unfortunately, with the standard deduction being as high as it is, most Americans find that they take the standard deduction.
That's true. But we always recommend our tax clients to give us all their information, even if you don't normally itemize. If you think in the slightest doubt that you might be able to, let us run the numbers and do what's most beneficial for you.
Yeah, great advice there to always kind of do that comparative analysis. I guess the next trend is one that, as I mentioned at the beginning of the program, I've started to look at some of the returns, all the returns that we do for our clients. I always kind of look at them before they go out the door, and I haven't looked at that many here in week one. But one of the ones that I looked at really caught my eye is they had gone from owing nothing last year to now owing over $4,000. Pretty significant swing, and that had to deal with a reflection of how well the markets have been doing. This notion that you're also going to be having more dividends, more capital gains, all of those kinds of things are also going to be a major impact on your tax return. In a lot of cases, those dividends and capital gains, oftentimes we're seeing that to be twice as much, sometimes even more, for folks that own investments.
Yeah, absolutely. Those dividends and capital gains can come as quite as a surprise to folks who are not expecting them. And so the actual taxation that you have to pay also increases your AGI.
Right.
So as with many of these things, it could affect other things on your return, not just the amount of taxes that you're paying.
Yeah, and for folks that don't realize that, where those come from is that typically a mutual fund is a pass-through entity. So any dividends that were earned for companies in that portfolio, if there was capital gains based upon internal trading inside that fund, all of that then gets passed pro rata to clients. And if it's a good year, then more and more of that gets passed. And then if it's a good year on the heels of several good years, then the number keeps going up. We're going to take a break here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Welcome to the show. You know, we're working through these 5 sort of early tax trends, but the reality is I think these are going to be trends that folks are going to see across the board this tax season.
Yeah, absolutely. So we've already talked about higher interest rates, both received and paid. We talked about dividends and capital gains. And then we're moving on to the next one, which would be Social Security. So your Social Security benefits that you receive, the taxation on that is based on your additional income. So if you have no other income other than Social Security, chances are you're not taxed. However, if you have other income in addition to your Social Security gets taxed at different rates up to 85%.
Well, and that's exactly kind of what happened on this return that I looked at this past week that went from owing zero the prior year to owing over $4,000. Those higher dividends and capital gains, which again are passed through proportionately as an owner of the fund. So if the fund owns a couple hundred different companies in it, and these companies are paying dividends, or maybe there's some transactions inside the fund that then create capital gains. And in particular, you see that after a few years where you've had a nice trend in the markets, where then these numbers really start to really be much bigger. And that's exactly what was happening with this person's return, is that because of the dividends and capital gains, her Social Security then became taxable, which then really has a pretty significant accelerating impact on the total tax picture.
Yeah, absolutely.
You know, it's interesting about that Social Security tax. I mean, as you were just describing, you have to get above certain thresholds in order for it to be taxable. And I think it's important to know, and I guess relate it back to the current headlines where we're hearing the conversation out of Washington about, we want to make Social Security tax free. Well, for some Americans, it is tax-free, particularly if you're below those thresholds. But what's unique about those thresholds is that they really haven't changed for well in excess of 40 years.
Yeah. Many tax codes are adjusted each year due to inflation. However, Social Security brackets are not.
Yeah, so what that means is then that every year, more and more Americans, because this hasn't been inflation adjusted for a 40-year period of time, more and more Americans are seeing that their Social Security is taxable, whereby previously it wasn't. And I guess that ties into the headlines. This current administration is talking about, I want to make Social Security tax-free. What's interesting is I think they can accomplish a lot just by sort of fixing this glitch, I guess, in the tax code, whereby the thresholds, just index them to inflation, and you'd pick up millions of Americans and put their Social Security back to be non-taxable, which is sort of what was originally contemplated, but the code hasn't kept up with inflation, and so more and more people unfortunately experience their Social Security to be taxable.
I mean, you make it seem so simple, but I'm sure we will spend, we meaning the government, much more time to fix that issue.
Yes, and there'll be a lot of headlines about it, and it will be, a new concept, if you will, but in fact, it's, an age-old concept. It just needs a little bit of adjustment. One of those rare things in the tax code, there's a few. That's probably the biggest one where there was not an inflation adjustment at all during the course of the time, where Social Security is typically treated on the return. So
we're definitely due for that.
Yeah. Absolutely.
Do.
So what's next? So we're continuing on with the early tax trends that we're seeing at the office at Nelson Financial Planning.
Yes. So the next one we have is something we're kind of seeing folks use across the investment world more and more. It's called a qualified charitable distribution, also known as a QCD. And a QCD is where you take a redemption out of your IRA account, and those redemptions are paid directly to a charity of your choice. And when you do it that specific way, the redemption from your IRA is then non-taxable to you. Still reportable, but it becomes non-taxable.
So that's a great feature.
Yeah, absolutely. Absolutely. So we've seen a lot of our clients, especially those of RMD age, if they no longer were able to itemize, they use this qualified charitable distribution to help get a little bit of a tax break on their tax return. And it's a way, in essence, to still keep track of your charity and get a little of a deduction for it. So the key components with a QCD is, as I said before, it must be made payable to the charity. It's one of the most important parts. It cannot be made payable to you, and then you bring the check to the charity. It has to be made payable to them. And one key factor is it does not have to be your RMD, or you don't have to be of RMD age. The QCD option starts at 70 and a half. So we're actually starting to see some folks realize that, whether we're explaining that to them or they realize it on their own, and they're able to get some deductions for those charitable contributions.
Yeah, definitely some logistics, though, that folks need to observe on this stuff, and specific process that they need to follow in order to make sure that it's done correctly.
Yeah, absolutely. Absolutely. One of the other key components is that you can only give up to $108,000 through a QCD per year. Now, that is a large amount, but if you do donate and that's the way you would like to spend your money, it's a great feature to save some money tax-wise.
Yeah, no, it really does, and it's a feature that's been around for a few years, but I do think it's important to kind of include it on this list of sort of early tax trends, because more and more people are starting to realize, as you were saying, the value of doing that. And it's great to see that trend. It's great to see that from a charitable giving perspective, but also great to see where folks are able to be much more tax effective or tax efficient by using this QCD approach.
Yeah, absolutely. I mean, I think that's where using a tax professional comes in to help utilize these approaches and just make sure you're doing it the correct way.
So the next up on the list is this whole Form 1099-K thing. Tell us a little bit more about that, Christina.
Yeah, so a 1099-K is a form that you would receive for goods or services that you perform during the year, whether it's from credit card or debit card transactions or online payments such as Venmo or PayPal. In the past, these forms had a threshold of $20,000, so many folks did not get these issued to them. But the IRS is changing the guidelines, and then starting in 2024, it's going to be a tiered system. So for 24, the guideline for getting this form is $5,000, and then it'll go down to $6,000 for 2025.
Yeah, it's going to be pretty low threshold for this year.
Well, even dropping from 20,000 to 5,000 is quite significant.
Catches up a lot of people. Be prepared. If you get that, then make sure you're putting that on your tax return. You may need to take a little bit of time to find it as well, because more often than not, these are through some sort of online or app type of provider, like a Venmo or similar.
Yeah, like a
app.
Venmo or PayPal, maybe like an Etsy or eBay, something like that, where they're not sending out forms electronically, and that's an issue we're seeing across many of our tax forms with clients providing us information, is that they're no longer mailing them out. You have to download the form and somehow get it to us.
Yeah, especially for those, the natural tendency is to select e-delivery. So you're right. I mean, a lot of it is you've got to, you may say, oh, I didn't get a tax form. Well, that's probably not enough in today's world. So you need to really dig into making sure that you found it. A couple weeks ago when Chuck Howard and Kristen Costello of Nelson Financial Planning hosted the program, they had a really in-depth discussion about this 1099-K stuff. So we would encourage you to go into the podcast archives and listen in on that if that's at all applicable to you. Really spend some time kind of working through this issue. And I think the key takeaway to remind people about, Christina, is you got to look for that form. That form is not magically going to come in the mail to you.
Yeah, absolutely. You have to look for the form. And one of my favorite comments to say to people is, just because you didn't receive it doesn't mean it wasn't issued to you. No. And the IRS does not care that you didn't get it in the mail. And I think the other key factor, too, just real quickly, is to note that you can write off expenses on it. So if you are a business, it in essence turns into like a Schedule C, like a business schedule. So you can write off some expenses. So it may be something you're not used to doing, and you need to make sure you're prepared for.
Absolutely. That is changing. IRS wants to know about everything that you do. That's the whole point of the 1099-K. Anyway, we're going to take a break and continue here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So we're going to shift some gears from talking about some of the early tax trends that we've already started to see in this tax season to talk about some of the famous or maybe infamous retirement myths that are floating around out there and see if we can maybe explain the reality of what's behind them.
Yeah, absolutely. Retirement is complicated. And because of that, there are a host of myths that are associated that just aren't true.
So in this segment of Dollars and Cents, we're going to try and work through and debunk some of these, or at least maybe not debunk, but bring perspective. And so the first one we're going to start with is actually one that seems to be sort of making the rounds among the headlines these days. And it comes from a recent poll out of Charles Schwab where they polled 1,000 401k plan participants. And according to the study, those polled believed that they needed to save at least $1.8 million to retire comfortably. That's a lot more than just kind of becoming a millionaire, isn't it?
Yeah, that's certainly a big number. I mean, you're almost multimillionaire at that point.
Oh, that's true. That's very true.
For most folks, especially what we see here, they don't even need quite that number, probably closer to half of that. So the misconception there is not so much how much you have to retire, but what is the level of income that you're going to need? And then also not to forget Social Security. I mean, that could be a good part of your retirement for many folks.
Yeah, I mean, I think if you start to break that down, and again, each individual is obviously going to be unique based upon their spending habits, and that's the danger of picking certain ages or for certain dates or certain dollar amounts in terms of describing retirement. Because as you said, Christina, we got a lot of clients at Nelson Financial Planning who have significantly less than $1.8 million, but are happily retired.
Yeah.
So it really is an individual discussion. I would say, kind of the average retired couple that we typically, work with on a regular basis, has income in retirement of around $100,000 a year. I mean, that translates to about $8,000 a month. Which, that's still a decent amount of income that's coming in.
Yeah, absolutely. So let's break that down for you a little bit so you can understand. If you have about $8,000 a month, let's assume we're talking about a couple. We could say about $4,000 of that would typically come from their Social Security benefits. And then the rest of that income, meaning another $4,000, would come from their investment accounts. So that's $4,000 a month is about $4,800 per year, which is a 4% withdrawal rate, which is generally what we recommend to help sustain your principal and take some income. You would need about $1 million,
yeah,
not
so
1.8.
That's not 1.8. So $48,000 a year, $4,000 a month, plus $4,000 of Social Security gets you a little bit close. So I guess the point of this one, and to provide perspective on it, is that everybody's number is unique, but you may find that your number actually works just as well for you without having to kind of hit some of these higher numbers that are floating around in the mainstream media, that's for sure.
Yeah, and I think that ties into our next myth, which is you can't fully rely on Social Security to support you through your whole retirement, especially just not the majority of folks.
Yeah, I mean, that is true. If you're banking on Social Security to be your sole source of income in retirement, it's probably going to be a little tight. That is for sure. I mean, Social Security itself was designed to be a safety net in the first place, and then as we were saying, average Social Security benefit per person somewhere a little bit under $2,000 for a couple. That's the $4,000. Certainly imperative to be able to supplement your Social Security with that extra savings you do along the way.
Yeah. So our next myth kind of ties into Social Security as well, and is waiting until you reach that maximum age of 70 years old to maximize your Social Security to have to retire. And the reality is there's just not a magical number. It's a little different for everyone based on, your lifestyle and what other, options that you have for us. And this circles back to, you need to figure out what is the level of income you need, not a specific number or age.
Yeah, that's certainly the exercises that we do every day at the office at Nelson Financial Planning. The harsh reality is that if you haven't saved enough, then obviously, the value of delaying taking Social Security all the way up until age 70 may make some sense, because that's when you can get the maximum amount. So if you haven't saved enough, you may find that you have to do that. The age that we typically kind of start the conversation at is 65, though, is kind of the number that we always kind of start chatting about.
Yeah, absolutely. And 65 is sort of one of those magical numbers because you're eligible for Medicare. And health insurance is one of the biggest factors we see for our retirees who are retiring before they're Medicare eligible. And that insurance cost can easily be over $2,000 a month for a couple. It's outrageous.
Yeah, no, it really is. Now, obviously, there's all kinds of other options for health insurance these days, but if you want kind of that coverage or continuing that coverage of what you had with your employer, yeah, it adds a couple of $1,000s a month. And if you walk out the door and say adios to your employer, chances are it gets a little hard to come back once you've sort of burned that bridge, if you will.
So that brings us to our next myth, which is the notion of having to make major changes to your investment allocation once you decide to retire. And the reality here is you should have been making those changes all along, capturing your growth and moving to a little bit more of a conservative position slowly.
Yeah, I think that's a fair point. I think the mainstream media would describe this as, you get to retirement and you have to make these big changes in terms of your investment allocation. The reality is, just as you're kind of gearing up for retirement in the years leading up to that retirement age, so too should you be doing that with your investments. And then that way, there's not any big drastic changes in your overall allocation, all at one shot. No sudden moves, if you will, but be doing it along the way as you approach that retirement age.
Yeah, you want to be careful about just not being too conservative too soon. And I think that's a huge retirement myth, especially some of what I call these cookie cutter investment firms. Once you hit a certain age, you got to have a certain percentage of bonds. And that's not necessarily the case for everyone. I think the big important factor to remember is you're not spending all your money at once. You're taking little pieces each year. So a good amount of your investment is still being invested.
Well, and it has to be, right? Because you've got the two risks, the risk of longevity and the risk of inflation, right? Inflation is, you're going to need more money over time to buy the same stuff. And then longevity, we're all living longer. So pretty important concepts to remember, particularly as it relates back to that investment allocation.
Yeah, and I think some of us, especially lately in the past several years, we've been spoiled with no inflation. And then here these past couple of years, it's definitely coming full swing. I mean, the cost of groceries, insurance, rent, all of that stuff has changed dramatically.
Adds up very, very quickly.
It does.
Yes. So an interesting conversation, if you will, here in this final segment of Dollars and Cents, where we tackle some of those, kind of did a rapid fire on that one. So that's good, because we wanted to really devote a lot of the time on the program this week to really talking about those early tax trends. So I guess, doubling back to that, bottom line, be prepared to pay more, or is that the bad news at the end of the day?
Unfortunately, be prepared to pay more, but hopefully you made more, or you should have.
Correct. You made more interest, you pay more taxes. You made more dividends, you pay more taxes. You made more cap gains, you pay more in taxes, unfortunately.
Yes.
So, but certainly important to run the analysis on an individual basis. That's, of course, what we do at Nelson Financial Planning during the course of the week. We thank you for listening in to this week's program here on Dollars and Cents. Hopefully, I've managed to survive my marathon. We're coming to the end of the program. As we mentioned earlier, we taped this on Friday because Sunday morning I'm running the Melbourne Marathon. So hopefully I'm coming to the end of that. I know we're coming to the end of the program, so at least we know that. And so we're going to wrap it on up and get on out of here. Thank you for listening to the program. If you'd like to schedule a conversation to see exactly what your unique retirement picture might be, just go to our website, nelsonfinancialplanning.com. There you can schedule one of those free conversations. With that, we're going to wrap it on up and get on out of here. This has been Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.